Hey everybody, hope you guys are all doing well. So today we're going to go through tax-free access to retained earnings inside of a corporation. So who's this presentation for? Any Canadian that owns an operating company. And what are you going to learn? How to get access to your retained earnings tax-free through a collateralized insurance contract. Why is this going to be interesting? Because I went down the rabbit hole hard over the last 1.5 years and figured out how to structure these insurance contracts extremely cheaply. So step one, how do we do this? We purchase a life insurance contract in your corporation. So here's that green box. We'll call that the life insurance contract. Step two, we put money into your life insurance contract. Step three, we secure a line of credit up to the cash value of your policy in your personal name. We go to TD, BMO, RBC, CIBC, Scotiabank, Manulife Bank. They all have specific programs designed specifically for this. Step four, we set up the correct accounting and legal structures to make this work. And from there, you now have access to your retained earnings through a line of credit. Here's a quick question. When does the line of credit get paid back? Well, you can pay back anytime that you want, or it'll get paid back upon death. And your life insurance will pay out and will pay out the line of credit. So let's go through an example. 40-year-old female, non-smoker, deposits up to $100,000 a year into the life insurance contract. So you see there, $100,000 a year going year out for the first 10 years. Cash value is just on the right of it. And this is all done inside of the company. We then go to the banks. We then secure a line of credit for pretty much the exact amounts that are in the cash value. The banks will actually go to 100% of cash value inside of a contract. And there you go. There's your line of credit in your personal name. So here's the thing. Why would you want access like this? Well, the reason is it provides massive flexibility on how you get access to your corporate earnings to your personal name. Here are your current options. One, you take it as an income or salary and you pay up to 53%. You got eligible dividends where your net operating income is over $500,000. You're going to pay up to 36% in tax on the personal side. Ineligible dividends where your net operating income is less than $500,000, which basically is a small business tax component, you're looking at up to about 48% or 48.89%. Number four, you do a shareholder loan. It's tax-free in the first 2 years, but if you don't pay it back in the first 2 years, you have to claim it as a dividend or income, which basically means you're going to get taxed up to 36 to 53%. Number five is using a collateralized life insurance contract where you borrow the money at 4%. At the time of this video, it's 4%-ish. Or the rate would be like prime minus a quarter to prime plus 1.5%, depending on what your financial situation is. And on top of that, the actual life insurance contract still has its cash value inside of the contract, and it's growing at 6%. So your money inside of the contract is growing at 6%. You're borrowing it at 4-ish. So in theory, you're making a 1 or 2% spread on borrowing your own money. But bottom line is this collateralized life insurance contract provides way more flexibility on how you can control access to your retained earnings in your company. So here's the question. Why doesn't everybody just do this? Well, the short answer is most people use 100% whole life to set these contracts up. The problem with whole life is that it's extraordinarily expensive to implement. What I ended up figuring out was how to use 5% whole life and 95% term insurance. By doing so, it reduced the cost to these contracts dramatically. So here's an example. Someone puts $104,000 and we've got 100% whole life, and the cash value is $50,000 in year one. So basically $54,000 disappeared. Now it does come back, but it takes 10 to 12 years to basically break even with these contracts. So the process is very slow with whole life. The other issue is the minimum payment associated with these contracts. The minimum payment in this scenario is $104,000 a year. Year in, year out, they have to front $104,000. So when I look at this, I'm thinking this is really designed for people to have significant excess money to implement. So what's the alternative? Well, if we did 95% term insurance plus 5% whole life, let's look at the numbers. Total annual premium, $100,000 in. Year one cash value, $93,000. That means we got 93% of the money that we put into this contract. That's after paying the insurance costs associated with the contract. The second issue that gets addressed is the minimum payment. Well, the minimum payment in this structure is $7,500. It's not $100,000 or $104,000. So if you have a bad year or something just goes wrong, you can't put that $100,000 in, well, the minimum in this structure would be $7,500. So basically in this contract, you can put $7,500 up to $100,000. So this provides way more flexibility than a traditional 100% whole life structure. So this is what I ended up figuring out. And by doing so, when I first saw the whole life structure, I thought maybe 3%, maybe 4% of businesses would want to use this. And now I'm sort of at the point where I'm thinking maybe 80% of people should be implementing this. If you think about it, what are we really doing? See, most people already own term insurance. And all we're doing is adding a 5% whole life component to a term insurance contract and owning it in your corporation. In return, you get the option to deposit hundreds of thousands of dollars to millions of dollars of your corporate retained earnings over time into the contract. You then structure a line of credit in your personal name, which gives you access to your retained earnings tax-free while you are alive. So, is it easy to set up? Short answer is no, it's actually quite involved. 3 structures that have to be implemented. You got to deal with your life insurance structure, your corporate structuring, and your lending structuring. All 3 have to be done flawlessly perfect to optimize these contracts. Now, are there more benefits beyond the line of credit structure? Short answer is yes, lots more. When we do a Zoom meeting, we go through a bunch more of them. But bottom line is this: if you are incorporated, you are already buying term life insurance, you are 90% already there from implementing this structure. Next step, send me an email to robert@robertklein.ca to set up a time to discuss this, or give me a call 778-896-6732.